The Watson Weekly podcast is sponsored by Miracle. Because traditional commerce is just code for not growing, it's time to do better than the status quo. Join 450 retailers who are scaling 6 times faster with AI, automation, and a platform built for what's next. Marketplace, dropship, and retail media at enterprise-grade scale. It's time to accelerate with Miracle. It's May 19th, 2025, and this is the Watson Weekly, your essential e-commerce digest. Today on our show, Amazon announces new AI tool to enhance product listings. Venture capital dominated by AI right now. FedEx and Amazon strike up a partnership. Klaviyo reports Q1 2025 earnings. And finally, the Investor Minute, which contains 5 items this week from the world of venture capital, acquisitions, and IPOs. But first, in our shopping cart full of news, Amazon launches AI tool to enhance product listings. TechCrunch reported last week that Amazon has launched a new AI-oriented tool to enhance product listings. The tool suggests titles, descriptions, attributes, and missing details. For a reseller, these types of tools are always great because they can help you make your listings better. On a marketplace, what these tend to do is level the playing field. In other words, if you were spending a lot of money on good data and then giving that good data to Amazon, you have now just trained Amazon's AI to help your competition. But then you kind of knew that already. For sellers who care enough to control their listings, now they have 2 jobs. One job they already had to update their own product data, and another job to monitor what Amazon is doing to ensure they don't introduce any inaccuracies. For Amazon, I'm sure they'll be able to show this is a great idea as it likely improves conversion and findability across their long tail. For the individual brand that already pays attention, however, it could just give them more work. Our second story, venture capital dominated by AI right now. PitchBook and the National Venture Capital Association recently released their Q1 2025 report, and I love tracking this information because I think it has implications for all founders out there. Here are 5 takeaways that I thought were interesting from the report. First, venture investments have continued on the 2024 phase, so things are steady. What's not steady is AI, which has consumed 71% of all capital investments so far this year. Second, there have been a few companies who opted out of the Q1 chaos to delay their public listings. This caused public IPOs to be even less prevalent than last year. Notable companies in e-commerce include Klarna and ShipBob, which both seem to have delayed their planned IPOs. Speaking of exits, they hit their highest value since Q4 2021, although 40% of that number was generated by a single IPO, CoreWeave. Not coincidentally, it's an AI company. Third, venture capital used to be historically a 5 to 7 year horizon for venture capitalists, with 10 years being the average lifetime of a fund. Not anymore. The average lifetime for a startup first round of funding to exit is now stretched to 12 years or more in some cases. This means that companies are staying private much longer. Fourth, and speaking of companies staying private longer, how are investors and founders getting paid without exits? That's what's called secondaries. Secondaries are when a new investor comes in to put money and cash out previous investors and employees. One of the most famous examples of this has been Stripe recently, which almost never seems to want to go public. Whereas late-stage growth rounds used to have a secondary component about 20 to 30% of the time just a few years ago, now that figure is over 50%, a huge shift in investor and founder behavior to unlock trapped liquidity. Fifth, and finally, acquisitions have started to become slightly more concentrated in early-stage companies. Pre-seed and seed stage acquisitions used to represent about 30% of all acquisitions. Now these 2 categories represent over 45%. Our third story, FedEx and Amazon partner for large packages. Recent news shows that Amazon and FedEx have signed a multi-year partnership for large residential packages. Reuters reports that Amazon's internal documents state that the rates provided by FedEx are better for the same parcel than those provided previously by UPS. This doesn't make me feel so good about the deal for FedEx, since about 60% of Amazon volume into UPS was not profitable. Amazon has historically had a big and bulky facility in the center of the country. With the company's new regionalized shipping network, likely the company needed more help in this area and found a partner who would take on this cost. Finally, with increasing automation in Amazon's network, it is also possible that Amazon was not able to easily automate the delivery of these parcels. which means Amazon was more than happy to pawn this off on a partner. All I can say is this: almost anyone who's on the other side of the table when Amazon does a transaction is a loser. I don't care if it's someone like Toys R Us for famously putting their website on Amazon, Kohl's for putting Amazon returns counters in its stores, or now FedEx. I don't think Amazon is on the wrong side of this deal. And our last story. Klaviyo reports Q1 2025 earnings. My summary of earnings is simple. Klaviyo continues to grow quickly, faster than Shopify, and is currently trading efficiency for higher growth rates. Here are a few takeaways from the call. First quarter revenue grew 33% year over year. Even higher than this are growth rates of customers with over $50,000 of annual recurring revenue at 40% growth of this segment, and EMEA growth rates of 47%. Unfortunately, to generate this revenue, Klaviyo had to spend a lot of money. Year-over-year sales and marketing costs were up 34%, while R&D costs were up 23%. This pushed down the company's net losses 9% worse. And I'll end on this note. Klaviyo now has over 169,000 customers total, representing a 16% year-over-year growth. And of those, about 1,000 customers are now paying over $100,000 a year in annual recurring revenue. This is a significant milestone for them, so congrats on the growth. I'm still bullish on Klaviyo as a product line and expect the company to continue to win business across a variety of e-commerce scenarios. It's that time, friends, for our Investor Minute. We have 5 items on the menu today. First, DHL Supply Chain acquires IDS Fulfillment, eyeing smaller e-commerce customers. DHL Supply Chain has announced it has acquired Indiana-based IDS Fulfillment for an undisclosed amount. The company will gain access to small and mid-sized e-commerce businesses that sell apparel and shoewear, health and beauty products, toys, and other goods. The deal was in place before the tariff announcements and is part of DHL's supply chain strategy of acquiring capabilities it doesn't offer currently. This is DHL Supply Chain's second acquisition of 2025 after it acquired North Carolina-based return service provider Inmar Supply Chain Solutions in January. Second, Skechers to go private in $9.4 billion 3G Capital deal. Skechers has announced that consumer goods private equity investor 3G Capital will acquire it at $63 per share in cash. The acquisition price implies an enterprise value of about $9.4 billion. Upon completing the transaction, Skechers will cease trading on the New York Stock Exchange. This is a leveraged buyout for a business that generates $9 billion in annual revenue, has 5,300 global stores, and a loyal customer base. 3G Capital is betting that Skechers will operate profitably in the long term despite tariffs. Longtime CEO Robert Greenberg stands to collect a $1 billion payout and will remain with the company alongside other executives to run it and retain a stake in it. Third, DoorDash buys UK rival Deliveroo for $3.86 billion. DoorDash will acquire UK rival Deliveroo for about 2.9 billion euros. The acquisition enables DoorDash to access 9 new markets, including the UK and Deliveroo's home market. After the acquisition, DoorDash will operate in 40 markets and service roughly 50 million monthly active users. The acquisition also enables DoorDash to better compete against rivals such as Just Eat Takeaway and Uber Eats to its larger scale and global footprint. It's unclear whether Deliveroo will remain independent or be absorbed into DoorDash's existing platform. Fourth, Rite Aid files for bankruptcy 8 months after exiting Chapter 11. Rite Aid, a drugstore retailer, has voluntarily filed for Chapter 11 bankruptcy in U.S. Bankruptcy Court for the District of New Jersey. The company is in active discussions with potential acquirers and is using the Chapter 11 process to pursue a sale of its prescriptions, pharmacy, and front-end inventory and other assets. It has secured commitments from certain existing lenders to access $1.4 billion in new financing. Per court documents, an auction is set for May 14th for the pharmacy assets and June 20th for the other assets. Who is buying Rite Aid? Walmart can't, and CVS is downsizing. And finally, Instacart acquires Windshop to expand the adoption of its enterprise technology solutions. Instacart has announced that it's acquired Windshop, a cloud-based e-commerce platform for grocers, at an undisclosed price. The acquisition will strengthen Instacart's enterprise solutions and enable retailers to enhance their online experiences. Windshop will initially operate as a wholly owned subsidiary of Instacart, and over time, Instacart expects to expand more of its enterprise technology solutions to Windshop's customers. Did you know that RMW Commerce has another podcast? Check out the Watson Weekend for an unfiltered and lively e-commerce chat each week with me, Rick Watson, my co-host Jess Liseski, and an array of interesting guests and topics, all focused on e-commerce. You can find the Watson Weekend by searching for it on iTunes, Spotify, or YouTube. That's all for this week. Till next time, Watsonians. Hi, I'm Rick Watson, CEO and founder of RMW Commerce Consulting and host of the Watson Weekly podcast, your essential e-commerce digest. Our production partner for the series is Podcast on the Fly. To hear new episodes of the show every Monday morning, subscribe now at rmwcommerce.com/Watson Weekly and wherever you get your podcasts.